Welcome to the BankTalk podcast, the show where we talk to leaders and experts from the community banking sector. Whether you are a current CEO or aspire to be one, this podcast will give you valuable insights and advice on how to run your financial institution better. Each episode features a different topic and a guest who shares their experience and knowledge with us. Tune in and learn something new with BankTalk podcast.
Hi, and welcome to BankTalk. I'm Charlie Kelly, your host and partner at Remedy Consulting. A few months ago, I attended a session on subordinated debt. I was at a conference for credit unions, pretty big, decent-sized regional conference. At the time, I joined a session, and for those of you who've done a few of these before, some of these sessions you get an awful lot of people, and some you get almost none. And you really can't tell the difference in the quality of the session based on the number of attendees. But there was a session on subordinated debt for credit unions, and the session was just entirely packed. So I thought I would get our friends at Piper Sandler together, see if they could explain to me why they felt this was a hot topic. I was kind of under the impression that subordinated debt in the bank space, at least in the short term, was somewhat dead. But for some reason, this was a full room of CEOs in the credit union space that seemed to have an awful lot of interest in it. So without further ado, let's get to BankTalk. We'll talk to a couple experts and see if we can shake out what's going on in the subordinated debt space on the credit union side. Okay, welcome back to BankTalk. Today I have with me Derek.szot, Managing Director at Piper Sandler. Derek, thanks for joining me.
Nice to be here.
So, Derek, we prepped for this a little bit, but I attended a session, a credit union session that was sort of focused on subordinated debt. And I walked into this session. It was a regional credit union meeting, and it was probably the best attended session I had found. And in my head, I was thinking, on the bank side, I thought subordinated debt, at least in the short term, was kind of a dead deal. Like there wasn't, there's not nearly as much activity as there might be going on a while ago. I sat in on the session briefly on the credit union side, and I just, a lot of the session went over my head. So I was hoping that we could just spend a little bit of time today and just kind of talk about why subordinated debt on the credit union side would draw this many attendees. If you don't mind, could you just give me a little bit of background on maybe why this is a hotter topic than it might be in the bank space?
Yeah, sure. It makes a lot of sense that seeing what you did was given that the rules for credit union sub-debt were just put into effect 2 years ago, so January of 2022. So for the credit union universe, it's a fairly new product. Since that point, a number of credit unions have availed themselves of it, but to a lot, it's still being discovered and understood. What does this mean? How do we utilize it? What is it for? How do we pay it back? All those questions. So not surprising that folks had those questions, and regardless of whether they're going to issue or not, they want to learn more about it.
When you say that this sort of got or opened up for the first time in 2022, if I reiterate that, is it fair to say that this is the first time that a credit union was able, or a credit union of a certain size was able to issue subordinated debt? Like before that time period, it wasn't really a thing?
There were small issues. Yeah, that's it. Getting into the nuance of it. There were small issuances done prior to that, but they were done under a different set of rules. So what the NCUA did was clarify how the capital is to be treated, how it's amortized, how it is paid back, and also the terms under which it was able to be issued. And that really cleared it up and for those folks so that there was a clear path as to what to do. Prior to that, it was more one-offs, small issuances here and there. But these rules set the terms, and folks have followed since. And every deal after that, those deals in January, have looked the same.
Okay. And if you wouldn't mind, maybe I should have done this at the beginning. But when I think of subordinated debt, I think of debt issued against an institution. When you talk about subordinated debt on the credit union side, give me a feel for the instrument and who might purchase the debt, right? Give me maybe a better feel for what I'd call the I don't want to say the infrastructure, maybe the ecosystem.
No, the structure is the right word. And what the NCUA tried to do was to create an instrument possible. So we had several conversations, us as a firm, prior to the new rules coming out, asking us how, because they knew we did a lot of bank debt. What does it look like? What should it look like on the credit union side to get investors interested? We want an instrument that they're used to, the structure and terms that they're used to seeing. And we sent them several examples. We sent them prospectus and other documents and say, this is how the banks do it. If you put something together that's similar to this, we can get outside investors into this product. And that's really what they were looking to do. They were looking to have outside money come into the credit union space for this capital.
Okay. So if you could walk me through a use case, I'm a credit union, and we'll just use $1 million because I'm sure the numbers are bigger than that typically. But let's say I'm a credit union that wants to issue $1 million in subordinated debt. This is not, me go find out a bunch of depositors. This is actually me putting an instrument against, liability against my operation, I think. Educate me on that. I'm sure I have that wrong to some degree. But could you, maybe step it back just a little bit and, just to make sure that the users understand this concept of subordinated debt?
Yeah, that's a great question. As it's basic, it is a borrowing. So it's not unlike for credit unions share certificate, which is their version of a CD account. And think of it like a 5-year CD with a stated term. Just the amount deposited is a little more than that average depositor. It has that term, and there's an obligation to pay that back. So the credit union is borrowing that money for that period of time. And so the obligation is just to pay it back at the stated term and at the stated date. And that's their obligation. The difference and the nuance is the regulator allows that borrowing to count as capital. So it counts 100% towards their net worth ratio for the initial term. In your example, that full $1 million would be added to the capital count of the credit.
So I want to unpack a couple things you said there. Let's start with this concept of, Derek, you run one credit union, I run another. You go issue $1 million in debt, and I need an investment on my side. So Charlie's credit union says, hey, I'll go pick up Derek's 100% of his debt because that fits in my investment portfolio. Is there sort of an old boys network there where one credit union could go buy the first guy's debt, second one could take the other ones, and would there be any benefit there? Or I know you said that this thing was structured so that folks outside the credit union space could buy the debt, invest in the debt, right?
Yes.
Help me understand that piece of it, if you could, real quick, and then we'll get on to a couple other things you just said that I want to talk about.
And it's a great lead-in. Well, they're obviously outside investors. You asked about that. Who would buy this? And in our examples, we've had insurance companies come in and buy this. We've had bond funds come in and buy this. We've had other banks come in and buy this credit union sub-debt. And there are other credit unions as part of that investor mix. But as part of the rules, and very specifically stated and different from other industries, if a credit union purchases sub-debt of any other credit union, they are not permitted to issue.
Okay.
So you have to be in one camp or the other. The nice part is there's a cure that if it's some date in the future you decide that in 5 years, you know what, I think I could use some of that capital for growth, you simply sell that instrument to another buyer, or when it matures, you let it pay off, and then you become eligible once again.
Okay, great. No, that's excellent. I appreciate that. Okay, let me ask one question on one more follow-up question on what you had mentioned before. You had said, and I'm going to try to quote you, but probably get it wrong. This ruling allowed the sub-debt to act as capital. Think of what you said there. What I tried to say to myself is, okay, right, every credit union is always kind of dealing with their capital account and whether or not capital to assets make any sense. You're saying that as I look at that sort of capital to assets ratio, this fits on the capital side, very similar to what? And if I were to correlate that to a bank, right? A bank might do the same thing by just raising capital, right? By selling stock. Am I thinking about that right, or do I have that completely wrong?
No, you do have it right. And this, if you're talking in bank terms, this would count as tier one capital for the bank, and it counts as that same level of capital towards the net worth of the credit union. As we know in the financial services businesses, there's regulatory capital and then GAAP capital. So what the accountants can, how you keep the books, and then how the regulators have you account for it. And there's slight adjustments, plus and minuses on either side of that. So to be clear, it won't count as GAAP capital, but it does count as tier one capital. Not to get too far into it, but for banks, the subdebt also counts as capital, but it counts as tier two capital for them in the regulatory calculations.
So really, I think when you said, I think you made a comment to the effect of, this sort of allows credit unions another opportunity, because a credit union can't necessarily raise capital the same way a bank can. The goal of this is, to some degree, is to say, hey, this is another way to raise your capital number without selling stock, which you really don't have the ability to do. Right?
That's absolutely correct. And that is the design of the NCUA board. Former director Rodney Hood was personally involved in the passing of this because he wanted to see a leveling of the playing field. He saw that a lot of the larger credit unions, or really any size above 500 million, they're able to issue, but they couldn't compete with the banks that had other capital instruments to issue and count towards capital. So he wanted to give them something, saying, okay, I know you can't go public. I know you can't sell shares and stock, but if you're a credit union that is looking to grow at something greater than your return on equity or your retained earnings, this is the ability to do so by issuing this subdebt.
We'll be right back.
If you're dealing with a technology vendor, consider giving Remedy Consulting a call. At Remedy, we're dedicated to helping our clients get the most out of their tech spend. If you're considering changing one of your major tech providers or are renewing a contract with a vendor, the Remedy team may be able to add some value. Our clients enjoy our deep experience working inside these major vendors, and that background helps us ask questions which eliminate headaches and expense for our clients. Sometimes that's immediate relief, in the way of your vendor invoices, and sometimes that comes in the form of contract language protection for a strategic move that you may want to make several years later. The group of experts at Remedy have years of experience in core systems, digital, mobile, payments, item capture, commercial banking, pretty much the whole gamut of technology for financial institutions. Remedy approaches the BankTalk podcast the same way we approach our client engagements. We always try to fill some knowledge gaps, but also just have enough life experience stories to remain entertaining. So if you're renewing a technology contract or you have projects going on, just need another opinion or a project manager from outside your organization, reach out to us at remedyconsult.net. Thank you, and we appreciate you downloading the BankTalk podcast. Now let's get back to our episode.
If you're a mutual bank, and I know there's not quite as many as there used to be in the 70s and 80s, right? But if you're a mutual, meaning you're not held as a stock bank, do you have the same, wouldn't you have the same problem? You can't raise capital per se. What would a mutual bank's option be? How does a mutual savings bank solve the same problem? Because they're not stock owned, right?
Correct. And they have the same issue, credit unions do. But we've actually issued a fair amount of subdebt, a tremendous amount of subdebt actually for mutual institutions. And what they have in their advantage is they have the ability to create a holding company. Credit unions don't have holding companies, but banks can.
Okay.
And what they'll do is they issue that subdebt out of the holding company, then downstream that debt to the bank as tier one capital, thereby getting that same treatment. So in other words, mutuals have availed themselves of the same product. They just have to go through an extra step of establishing a holding company to do so.
Okay, and they treat it as a pass-through of some sort, yeah.
Correct. And to be clear, that's a non-public mutual holding company.
Right.
So the other option would be to go public and issue shares, but if they want to stay in the mutual form, then they go through that extra step, establishing the holding company, raising debt and downstreaming, and in effect have look very similar to what we just described as a credit union net worth ratio, counting that capital.
Okay. And the difference is that the credit unions just got this opened up to them in 2022, where this might not even in the mutual space, this might not have been a attended session because they've already known about it and have been doing it for years. Is that a fair statement?
No, that's correct. We've been issuing, and in fact, for some mutuals, we've done 3 rounds of it already. Typically, you asked about structure earlier. Typically, this has a 10-year life, but a 5-year structure in which it can be repaid or refinanced. So we have some that have already gone through the 5 years, refinanced, and issued additional. So it is a more mature market.
That's very interesting. Okay, so the next question I have for you is, there was an argument made in this conversation that I was listening to, and again, some of this was going over my head when I was listening to the subordinated debt presentation, but there was an argument made that if you take in X number of dollars, call it $1 million in debt, subordinated debt, that you could potentially, as a credit union CEO, leverage that into a lot more loans, and I'm going to again paraphrase, but a lot more loans on the other side of the books. In other words, 1 million might become 8 million or 5 million or 4 million or something along those lines. Could you explain that dynamic? Like what's the concept there? What's that leverage mean to the common man?
Yeah, and that's very simple. I mean, the financial services universe is built on leverage. I mean, banks have the same thing. They have a dollar of capital, and if they only lent out that dollar, then there would be leverage would be 1 for 1. Now, the ability of institutions to lend out something greater than that. So instead of lending out just $1 million on the proceeds, they're able to lend out $5 million in credit union membership. So you take 1 million, turn it to 5 million of loans, and as you think about a capital ratio, 1 million of capital over 5 million of assets, that's a 20% capital ratio or net worth ratio. So that's very well capitalized. So you're not over levering. Once you get beyond 10 times, let's say $1 million making $10 million of loans, that'd be a 10% leverage ratio.
And you're starting to squeeze.
And that's really about the level of exactly. So that's what the institutions will look to do. They'll look to leverage the capital. The important distinction of the debt that some people don't get originally, it's not financing or borrowing, because if you were just to say, well, I need to borrow money to fund these loans, you would just go out and raise CDs or borrow money from the home loan bank at something much cheaper than what the yield of this debt is. The fact that the debt counts as capital is the real key to why folks should look at this as a potential alternative for their growth plans.
So is it fair to say that if the debt is costing you, I'll use a number, 5% in interest, and you can make 5 loans at 5% in interest, the value of the leverage is that you're actually making more than you're paying out the backside. And it is because of that leverage. Like in other words, even if the debt would cost you 8%, after leveraging it 4 or 5 times over, the income stream from that higher level of borrowing greatly offsets the dollar amount that you're paying out the back door.
I think you're exactly correct the way you described that. And when we run our break-even analysis, it's anywhere from 2.5 to 5 times of leverage is that break-even point. So to the extent you lever more than that, you are generating income above and beyond what you would have done had you not gone through that process.
Okay. Because my other option, if I think about it, if I'm a credit union, I'm the CEO of a credit union, is to go borrow some money from the Federal Home Loan Bank at 3% and hope to get 6% when I lend it out. And that's not nearly the leverage of something like this.
Correct. That's a 1 for 1. That's funding. You're going to fund that in that 3% spread, but you need capital to support that, and that's what this borrowing does. The capital support that growth. Mm-hmm.
Okay, gotcha. Yeah. So it both allows you to borrow up to higher limits, and you also have this value of the leverage that goes along with it.
That's right.
No, that's helpful. Like I said, this is not necessarily my area of expertise, but it's sort of fascinating to me when you look at the dynamics around it and why. Again, I was in my head, I was trying to determine why this thing would be well attended, and I'm getting my head around it. Specifically, that January 2022 date that you talked about earlier.
Yeah, and the folks we're talking to that are issuing this, they come to us, and it is a growth story. They say we have opportunity to lend, we have opportunity to expand our membership. But if we do that, we're going to go below X% net worth. And our board and our management has a certain comfort level. And that level is different for everyone. For some it's 8%, for some it's 9%, for some it's 11%. And they say, well, we just operate with a leverage ratio in mind. And if we want to grow ahead of that, we're going to need to bring in extra capital to meet that extra demand we're seeing. And it's in markets. I mean, it's a tough market out there. Well, seeing the growth is not what it was in 2019 or 2020, but there are spots around the country, and other institutions are seeing opportunities to pick up share and market share and loans, and they want to take advantage of it.
That's great. No, that's excellent. Okay, I think I only have one more question for you, and that question is this: if there's got to be a sweet spot for this, like I think I heard you say in maybe not so many words that you've got to issue a certain amount of this debt and you have a certain time period and you very likely have some higher expenses to issue this than you would other scenarios. Like at what point do you think of, hey, it's not even worth bothering unless I'm issuing 30 million bucks? Or is it, is there a number there that, if you're a CEO of a credit union listening to this and based on your size, et cetera, is there a number upon, below which it doesn't make any sense to even look at this?
No, I do think it's all relative to the size and what you can do with it. The NCAA rule says anyone above 500 million can issue. And if they can put that money to work and show there is an application process, show the NCAA we have a plan for this and they're approved, then it does make sense.
Okay, but they have to be 500 million in assets in order to even get into the game. So
right. there's actually two requirements: the 500 million in assets, and they also have to be a low-income designated. That's an important thing, maybe upfront, but I think all the credit unions listening will know what that means. They have to be low-income designated upfront in order to apply and be approved for this.
Oh, so, all right.
But there are out of the universe, it's those that are low-income designated, are in the thousands. So we're not talking about a very small amount of the credit union universe. We're talking about a pretty good one because credit unions were designed to serve the underserved. So they're already in the membership base.
Okay. No, that's excellent. Is there a downside to the issuing this debt, from either a risk perspective or maybe I should ask that question a little differently. Is there a downside to buying this debt and making sure you're getting paid back at some point?
Yeah, there's two sides to the coin, and I think that's just it. If you're looking to invest in it, you got to look at it the same way that you would look at making any loan to a member, or to a business that is a non-member loan. What is the ability? What's the credit of that underlying institution, and will they pay it back? For some, they look at it, and some of the ones that issue have been top-rated, top-performing institutions in the credit union universe. And they say, well, I'd love to own that. I'd rather make that loan than a residential loan, and it's paying me X% more than that loan pays. And so it gives them a nice return on what they feel is a better credit. Now, there's credit up and down the spectrum, and you want to look closely at someone that has a very low return on average assets and say, okay, do they have the ability to debt service this? And that's just the credit analysis that I think every institution should do as they go about it. And the same time from an issuer, they should go through the same thing and say, this is going to be our debt service. This is how much we're going to cost of carrying this. Can we afford this for the next 5 years? And how are we going to pay it back?
Right.
So from both ends, they should be doing that analysis and that calculus and making sure that they can afford it.
Okay. No, that's great. I think just as guidance to a board of directors, because the board of directors may or may not, within the credit union space, may or may not be heavily into the financial side of this, but the concept of debt service is pretty important, or at least asking the right questions there, right? Great. I think I covered everything that I wanted to cover, Derek. Was there anything else you think we need to talk about in this space?
No, I think folks that remain, it's pretty simple. We do a lot of education on this product to help folks get familiar with it. But the fact is, as an institution, credit unions are borrowing every day. They're borrowing money from the Home Loan Bank, or they're borrowing from their members. This is just another means of doing so, but it happens to count as capital. I think that's really boiling it down to simplicity. So a couple of simplistic terms. That's what you want to keep in mind.
Okay, excellent. All right, well, Derek, I really appreciate you taking the time to join us today on Bank Talk, and it's been very informative. Like I said, you certainly filled in some blanks that I couldn't get my head around to prior to our conversation. So hopefully you've got the same thing. The listeners will feel the same way. So thanks for joining us.
Thank you again.
So that's it for Bank Talk. I appreciate everybody spending a little bit of time with us. Have a good day and keep on learning.
Thank you for listening to the Bank Talk podcast, brought to you by Remedy Consulting. To reach out to Derek at Piper Sandler, go to pipersandler.com or see the show notes for his email address. Thanks again, and we will see you in the next episode.